Alex.
Hey guys, can you hear me all right?
We can, yeah. Hello, Alex.
Great. I had a question related to one of your earlier videos when you were talking about capitalizing a one-time EPS stream. You talked about how oftentimes an increase in EPS is accompanied with the market bidding up the PE, and got me thinking about large price swings in equities. I was curious if, in your experience, when there's a large price swing, is that more likely to be accompanied with a mispricing versus, say, a stock that's been roughly flat, or is there generally, nothing to see there?
I'd say, I'd say, um, not always, but often elevated volatility is kind of seen as an opportunity. I don't think it's as like, I think the inverse can be true as well too, where a stock goes nowhere for 9 months and it looks like there's not much going on underneath the surface. But if you actually analyze the business, some kind of real important things are happening and you're getting ready for an inflection in the fundamentals. And that's indicative of real opportunity. So I don't think that just high degrees of volatility alone are a sign of opportunity. But listen, when you're covering a space and you see a United Health down 50% or some big volatility, something happening, I think the general framework we use in idea generation is equilibrium tends to be pretty well priced by markets, right? When businesses are stable, steady, predictable, there's not much debate or discussion, the market does a pretty good job of pricing those cash flows. When there is change and chaos and inflection, misunderstanding, visibility increase, decrease, those tend to be the situations where you tend to have more or a higher return on process. And so um, that volatility can be an opportunity. Now, as we get to later in the program, we talk about adaptive risk reward. Just because the stock's down 20 doesn't mean that's a buy, right? A stock down 20, if the growth algorithm just went from 10 to 2 and guidance, numbers are going down by 20%. So you're cranking down the numbers and cranking down the multiple. That could mean the stock goes down another 20 on top of that. So I think um, having a system to understand how stocks should move based on the fundamental outcome is a primary tool. Andrew, what would you add to that?
Yeah, I would add that when you see a large move reflexively, you want to say, I'm dispassionate, I run into a burning building. Um, the problem is you don't know when the fire is going to stop and you haven't calibrated whether the fire could grow larger. To Brett's point about understanding the fundamentals, um, anybody with a Bloomberg can see that there has been a large move in the stock, but whether or not the stock is interesting, long or short, depends substantially on your calibration of what is coming next. So stocks that appear overvalued will, always be too expensive to buy. And then the day that the company is fairly valued, it will have lost its luster and no one's going to want to buy it. It's just one of those anomalous things. In terms of one-time EPS streams, we talk a lot about how investors extrapolate into the future and into the terminal value, really, which can lead to a lot of these large price fluctuations. Recent fundamental developments. As you think about what's repeatable in your process, you really want to be on top of what are the one or two key drivers for the stock. And usually these have a significant relationship to the free cash flow generation long term of the stock. You want to be on top of those. And then when there's a big price move, ask, okay, hang on though, what changed? And I have a little heuristic that I use whenever I see a big move. Reflexively, you're going to think one thing or another thing. I just ask, too much or not enough? And then I say, should it have been bigger? Why wasn't it bigger? Or why should it have been a smaller move? And then that usually steers you right back to the fundamentals. So The other heuristic I use a lot, and you can find this in the 10K, is what items are one-offs and what items are recurring. Because understanding what is recurring versus one-off can factor very materially into your forecast, projections, and expectations of the future.